Hello, Bullish community. This is Certified Master Coach John Randall. We hope you're having a bullish day in the neighborhood. We have a wonderful, another monthly edition of our Bullish on Business series. And today we've got some great things around client experience. A lot of you are always trying to enhance the experience of your clients doing business with you, which really goes back to how do people feel about doing business with you? What is the result? What is the feeling that they get? So enhancing this is so critical. The better clients feel about doing business with you, it keeps them around. It builds a moat around them and keeps them there. The other great thing it does is it promotes referrals. So if you want to grow your practice, one of the most critical things to work on is your client experience. It enhances what you do with your people. It keeps them around. It will lead to new people. Our D2 investment guru, Drew Watson, he's got some great things. He has a top practice, one of the very top practices in the country, and he's got a wonderful client experience. He's going to share some things around how he is enhancing the client experience. We also have an investment update from him, so you can hear what he is doing in his portfolios, what he is saying to his clients. And we also have a very special tribute to Gunnery Sergeant Hartman. Passed away this week, a great actor that probably most of you recognize. There were several motivation techniques that you can certainly use with your team. So got a special tribute to him. But everyone stay bullish. Look forward to seeing you in upcoming coaching sessions. Take care.
You know, David Coverdale with Whitesnake once said, "Here we go again." And that's what I feel like with the stock market. Basically, since the end of January, we've had a pretty good 2-month stretch of what I would consider getting back into normal volatility. It seems worse than what it really is because the numbers are just larger. The last time we had this volatility, the Dow was probably 10,000 points lower than where it is now, and the S&P was several hundred points lower. But in effect, what we've had as evidence today is the VIX is about 17. That's the normal range, normal number for the VIX. But we came out of about a 14-month prolonged time frame where volatility was virtually non-existent. So what does that mean? Well, as of mid-April, what we've seen is with interest rates, the 90-day T-bill rates up to just under 1.73. The 10-year Treasury today went out at 283. The highs of the year were about 295. We started the year, I think, around the 260 level. So although rates are up, they're very, very much off their highs. Probably since our last webinar, what we've seen is crude oil prices have probably had the biggest move. Crude today is down about $1, but we went out last week well over 67, and we had a several session move to the upside. Part of that is global growth, demand for oil, and then now what we're starting to see is some of the realities of the uncertainty and instability in the Middle East are coming to the forefront. It looks to me, with crude, that the U.S. will be the swing producer, if they not already are, anytime in the near future. Also, one head-scratching sector that many of you continue to invest in is with the MLP oil and gas transportation stocks. Those stocks, many of them since our last time we were together, have hit fresh lows, if not all-time lows. One thing to hold out for will be when U.S. liquefied natural gas production really hits its stride. The rest of the world that has a lot of gas, such as the Emirates States, Saudi Arabia, they do not have the infrastructure in place to export at a pretty large clip. This is a multi-decade build-out. The U.S. has been steadily investing more and more money in these areas, probably for almost that time, and several large liquefied natural gas places will go online, and that's something worth kind of watching. So when it comes to stocks, basically what we've seen is consumer discretionary and tech lead the way this year performance-wise. Your laggards are going to be consumer staples, utilities, and the such. Financials have been just so-so. With rising rates, I think everybody was excited to see what might happen on the financial side. Bank stocks, larger bank stocks, have performed better per se than large insurance companies. So there is quite a bit of dispersion between how Bank of America, J.P. Morgan, Citigroup have done versus, say, MetLife and Prudential. The consumer staple space has been crushed pretty steadily. I'm looking now, Altria Group's around 64 and a quarter. That's about where it's been trading all year. Industrials have also not had that great of a year. So it's been kind of a yin and a yang, where definitely growth is trumping value, pardon the pun. And what we think is that earnings, which earnings season started late last week and is going full steam now, as earnings come up, that should produce a pretty good backdrop for equities in general. I think we're going to start seeing the fruits of the Tax Act and tax reduction on the corporate level. I think many individuals will start noticing that probably their tax liability next year, or the 2018 year that they'll file next year, may not be as high as what they anticipated. And that should help be a tailwind to the consumer discretionary stocks, virtually like what they've had all year. In the alternative space, it's a mixed bag. REITs are down because rates have gone up. That Blackstone mortgage trust that we use, it's held its value. I think it's down modestly for the year, still producing a pretty good dividend. But I think the shock in interest rates has kind of really sent the alternative space scurrying as it pertains to REITs. Gold has continued to do pretty well. It's done better than silver. We looked at some client accounts where we put gold in mid-December 17. Those are up about just under 8% in the 4 months that we've owned it. It is clear that when we get more geopolitical risk and the such, gold continues to get a bid, and I think that will continue to be the case. I would continue to stress to look at preferreds in the fixed income or alternative space, whichever space you would like, as well as convertible bonds. Both of those can add a little bit of bang for the buck for the risk tolerance. I do think it'll be interesting to see what the market does between now and our next get-together. If earnings continue to come out pretty strong, I would anticipate we get a lift for the market in general, and we just need to see how much of a lift that we get. I think last week was a pretty good week for stocks. The first time in several weeks that we had a positive week kind of across all the larger indexes. What I would call shiny point right now is the smaller stocks have done pretty well year to date versus large. That's a sign that we've got maybe a second wind coming in this rally. That is getting a little bit long in the tooth. It's multi-year, but we're still under our average time for post-World War II recovery rallies by probably 8 or 9 months. And some rallies have lasted longer, and we'll see if that will be the case as it comes to in the U.S. Finally, we'll close on international stocks. We still like the international space, probably like emerging markets better than developed. China eventually will become a problem. Their economy is doing very well, but their banks are lending at rates that are frankly almost unsustainable. Eventually all that's going to come home to roost, and you just need to be careful and kind of weigh what your allocation is there. Developed Europe continues to do pretty well, and looks like year to date Japan may even be a laggard out of the developed economies. The one place we are avoiding completely is Canada. We think Canada's got a lot of real estate problems, and their economy, the main drivers in Canada, still is not on full and fair footing, I would say. So we're kind of staying out of Canada, but we like other, pretty much everything developed and emerging markets as a whole. Until then, we'll catch up to you next month. Today, April 16, 2018, we come to you with heavy hearts at Dynamic Directions. I've ordered all flags to fly at half-mast in honor of the passing of our beloved Sergeant Hartman. Sergeant Hartman had been at D2 for years, offering motivation for all of our employees here. I've had Ben put a little audio in to remind us that we should never do anything to dishonor ourselves or the platoon, and we all need help with self-discipline. This audio clip will provide great backstory and set the mood for our upcoming calls about how to better our operational capabilities within each financial practice and how to motivate your employees.
Private File has dishonored himself and dishonored the platoon. I have tried to help him, but I have failed. I have failed because you have not helped me. You people have not given Private File the proper motivation.
Hello, today we're going to talk about client experience and protecting your book. Specifically speaking, information that we had at the latest Forbes conference early in the spring talked about the fact that almost 80% of all widows change advisors after their husband dies. And there's lots of reasons for this, but one thing that we can do as advisors to help make sure this doesn't happen is try to meet with both husband and wife as often as possible, and also treat the wife as if she is the client. Let's don't just say, Ben and his wife. Let's treat both parties as the client, and especially the lady. Studies have found this helps retain the business. It helps the wife feel like she is part of the decision-making process on an equal footing with her husband. And more importantly, it's going to basically enforce that comfort level that should be there between an advisor and a client. Also, another area that can help with this, obviously, is getting children involved, especially adult children, in the conversation so they feel like both mother and father are getting great advice, and that either party, no matter who predeceases whom, the survivor will be in good hands. Topics that we often discuss in these types of meetings would be, kind of, you can call it a fire drill or a death scenario, looking at what the survivor's income tax situation would be the year after death. This helps kind of bring your value home to whoever the surviving spouse will be, that you can kind of help them get through this. It also brings to the forefront that there will be changes that goes on their tax filing status, and more than likely what their tax liability will be. There will also be changes with their Social Security benefits and how all that will work together and how you can help quarterback that situation. When handled correctly, obviously you'll come across as a trusted and really an advisor that they can't do without, which will help you retain that business. I was frankly stunned to see that the numbers were that high in our industry. I think in our practice it has not been, but I think we do a good job of relating to both parties. But industry-wide, it is a giant concern as more and more traditionally ladies outlive men, and as these baby boomers start to pass in large numbers, you're going to have a great relationship with both parties in the marriage and treat both as clients. So that's just one tip we think can help you retain more assets as you go through your practice. Good luck. Just like you've seen previews of the new Han Solo story, you're going to get a preview that will hit our desk about the same time as that movie does theaters this summer. Basically, what we've been working on is to try to create a better experience for our team that supports me around follow-up letters and all kinds of other deliverables that have to be done. One of the best practices we are exploring is recreating our meeting agenda that we see internally that we take notes on in order to make it literally the follow-up letter. This should help speed delivery of follow-up letters with additional information. What we're also working with, because the letters from myself have been really conversational in tone, is to kind of marry a conversational introduction and closing paragraph with more data driven from the meeting, and also a section of what we discussed along with what homework assignments the clients might have to get things back to us. We feel like this could be a home run for clients. One, it'll make things much clearer, but more importantly for our team members, it will hopefully make their jobs easier of getting together the follow-up information and getting it out the door in a much faster, completely accurate, and timely fashion as compared to just dictating everything, waiting for them to come in and handing the letters that way. We'll let you know how it goes, and if it's a success, you'll have all the information that we use up on our website in no time. Thank you, and have a great summer.